They always ask me what I'd buy if I had to live on a fixed income. 7 stocks they want. 7 names that won't blow up their retirement. 7 companies that understand the difference between clever and stupid. Well, I'll give you 7. But first, let me tell you why most investment advice for seniors is garbage wrapped in good intentions. People think age means you should run scared, hide in bonds, cling to cash like a life preserver. That's nonsense. Age means you can't afford mistakes. But it doesn't mean you should guarantee poverty through excessive caution. The biggest risk at 70% isn't volatility. It's outliving your money because you were too timid to let it grow. I've spent decades watching retirees destroy themselves with kindness. They buy what feels safe instead of what is safe. They choose comfort over arithmetic. They'd rather lose slowly than win steadily. That's not wisdom. That's fear wearing a sensible sweater. Recognition and the mathematics of addiction, not chemical addiction, habit addiction, the addiction of familiarity. Coca-Cola sells its products in over 200 countries. Their distribution network is so vast and entrenched that competitors would need decades and billions to replicate it. They don't just make beverages. They own the infrastructure that gets those beverages to consumers everywhere on Earth. The dividend yield isn't spectacular, but it's reliable and growing. More importantly, the business generates enormous amounts of free cash flow, cash that gets returned to shareholders through dividends and buybacks. For retirees, that means income you can count on, plus the potential for capital appreciation as the company continues expanding in developing markets. People worry about health trends and declining soda consumption. Fair concern. But Coca-Cola isn't just Coke anymore. They own water brands, sports drinks, juices, and coffee companies. They adapt to changing preferences while maintaining their distribution dominance. That's how great businesses survive and thrive across generations. The 4th recommendation is Walmart, the world's largest retailer and a company, they. T gets stronger during tough times. When consumers tighten their belts, they shop at Walmart. When the economy booms, Walmart captures more of that growth. It's a business model built for all seasons. Their competitive advantage is scale and efficiency. No one can match their buying power or distribution network. They squeeze costs out of everything they touch and pass those savings on to consumers. That creates a virtuous cycle where lower prices drive higher volumes, which enable even lower prices. For seniors on fixed incomes, Walmart represents both an investment opportunity and a practical benefit. You'll earn dividends from owning the stock while saving money shopping at their stores. That's what I call alignment of interests. The e-commerce threat to traditional retail is real, but Walmart has been adapting aggressively. They're combining their physical store network with online capabilities to create something Amazon can't easily replicate. Same-day delivery from local stores, curbside pickup, and grocery delivery. They're using their scale to compete rather than hide from change. Microsoft rounds out the first 5 selections. This might surprise people who think seniors would avoid technology stocks, but Microsoft isn't a typical tech company anymore. They've evolved from a software vendor into a utility that businesses can't function without. Their Office suite dominates corporate productivity. Azure cloud services compete directly with Amazon's offerings. Windows still runs most of the world's computers. These aren't products that get disrupted easily. They're infrastructure that the modern economy depends on. The dividend started relatively recently, but has grown rapidly. More importantly, Microsoft generates massive free cash flows that support both growth investments and shareholder returns. They're not burning cash to chase growth like younger tech companies. They're printing money from installed bases that face enormous switching costs. For retirees, Microsoft offers exposure to the technology sector without the volatility of speculative plays. You're buying proven products with massive moats rather than betting on the next big thing. That's appropriate for people who can't afford to be wrong. The key insight about all these companies is they're not exciting. They don't get headlines or generate cocktail party conversation. They're just quiet. Lie compound wealth year after year while flashier investments crash and burn. That's exactly what seniors need. Boredom that pays dividends. The sixth stock deserves special attention because it represents something most investors overlook. Berkshire Hathaway itself. Not because I'm biased, though I obviously am, but because it's designed exactly for the problem seniors face. How do you own a diversified collection of excellent businesses without having to research dozens of companies or worry about management changes? Berkshire is essentially a permanent holding company run by people who think like owners, not operators trying to impress Wall Street quarterly. We own pieces of Apple, American Express, Bank of America, and dozens of other businesses. But more importantly, we own entire companies like Geico, BNSF Railway, and Berkshire Hathaway Energy. These generate billions in cash flow that never gets distributed as dividends, but compounds internally. The beauty of this structure for retirees is simplicity. You don't need to monitor 20 different stocks or worry about which CEO might do something stupid. You're buying into a collection of businesses selected by people whose PERS. Ono wealth depends on making smart capital allocation decisions. When we make mistakes, and we do, they're cushioned by the sheer diversity of our operations. Critics say Berkshire doesn't pay dividends. They miss the point entirely. We compound your wealth internally at rates that would be impossible to achieve if we paid out cash for you to reinvest after taxes. The stock price reflects this accumulated value over time. For seniors who don't need current income, this is far more tax efficient than collecting dividends. But here's what really matters for older investors. Berkshire is built to survive anything. We carry enormous cash reserves precisely because we've lived through enough disasters to know they're inevitable. When markets crash and credit freezes, we have the resources to take advantage rather than get destroyed. That's insurance you can't buy anywhere else. The seventh and final recommendation requires careful consideration because it challenges conventional wisdom about senior portfolios. Visa represents the future of money, but in the most conservative way possible. They don't lend money, so they don't take credit risk. They don't hold inventory that can become obsolete. They simply facilitate transactions and collect a small fee on each one. Every time someone swipes a credit card anywhere in the world, Visa gets paid. The global trend toward cashless transactions is unstoppable, driven by convenience, security, and government preferences for trackable payments. This isn't some speculative technology play. It's a toll booth on the highway of modern commerce. The competitive mode is network effects and regulatory barriers. Merchants accept Visa because consumers carry Visa cards. Consumers carry Visa cards because merchants accept them. New entrants face the impossible task of convincing both sides to switch simultaneously. Meanwhile, the regulatory requirements for payment processing create massive barriers to entry. For seniors, Visa offers something rare in today's market: exposure to global economic growth without the risks that typically accompany it. As developing countries modernize their payment systems, Visa benefits. As e-commerce continues expanding, Visa benefits. As governments crack down on cash transactions, Visa benefits. You're riding secular trends rather than fighting them. The dividend yield starts modest but grows cons. Instantly, as the business generates more cash than it can productively reinvest. Unlike banks that face regulatory capital requirements, Visa can return almost all its excess cash to shareholders. That means dividends and buybacks that compound your ownership stake over time. Now, let me address the elephant in the room. These 7 companies aren't going to make you rich quick. They're not going to double in 6 months or generate options trading profits. What they will do is preserve and slowly grow your purchasing power while you sleep. That's what senior investing should accomplish. The mistake most older investors make is chasing yield in the wrong places. They buy high dividend stocks without understanding the businesses behind them. They purchase bonds that guarantee losses to inflation. They invest in real estate investment trusts that are interest rate sensitive. all because they confuse high current income with safety. Real safety comes from owning pieces of businesses that can raise prices faster than costs increase. Companies that have pricing power don't get destroyed by inflation. They benefit from it. When everything gets more expensive, their products and services get more expensive too. That's how you maintain purchasing power in an inflating world. These 7 stocks share common characteristics that matter more than their individual business models. They have durable competitive advantages that protect market share. They generate cash flows that exceed capital requirements. They're run by managers who understand capital allocation, and they operate in industries where demand is stable or growing. More importantly, they're boring. Boring is undervalued in investing because it doesn't generate excitement or trading commissions. But boring businesses that compound at reasonable rates will make you wealthier than exciting stories that crash when reality intrudes. At 70 or 80, you can't afford to learn that lesson the hard way. The portfolio allocation matters as much as the individual selections. Don't put everything into one stock, even if you love the business. Diversification isn't about owning 50 different companies. It's about owning different types of excellent businesses that won't all face the same risks simultaneously. Healthcare, consumer goods, technology, infrastructure, financial services, and global payment processing represent DI. Require taking maximum risks. Minimum regret requires taking intelligent risks with businesses you understand. Regret comes in 2 forms for older investors. The regret of losing money you can't replace, and the regret of being too conservative and watching inflation destroy your purchasing power. Both are painful, but only one is reversible. You can recover from temporary market losses if you own good businesses. You can't recover purchasing power loss to decades of excessive caution. That's why owning these 7 companies makes sense, even if they're not the highest returning investments available. They're the most sleep-worthy investments available. When the next recession hits, and it will, you won't be wondering if your companies will survive. You'll be wondering how much of their competitors' market share they'll capture while others struggle. Consider what happened during the 2008 financial crisis. Banks failed, real estate collapsed, and the stock market lost half its value. But people still bought Coca-Cola, shopped at Walmart, and used Microsoft Office. These businesses didn't just survive the crisis. They emerged stronger because weaker competitors disappeared. The same pattern repeats in every economic downturn. Strong companies with competitive advantages use difficult times to expand market share, acquire assets cheaply, and position themselves for the eventual recovery. That's why their stocks often perform better in the years following crashes than they did before them. For seniors, this creates an interesting dynamic. The companies that feel safest to own during good times are often the ones that perform best during bad times. It's the exact opposite of what most people expect. They assume safety means avoiding volatility, when really it means owning businesses that thrive regardless of external conditions. This is where most financial advisors get senior investing completely wrong. They focus on asset allocation models that reduce risk by adding more bonds and cash. But bonds and cash don't reduce risk in an inflationary environment. They guarantee losses to purchasing power. The real risk reduction comes from owning more of the right kinds of businesses, not fewer businesses overall. The mathematical reality is stark. If inflation runs at 3% annually and your bonds yield 2%, you're losing 1% of purchasing power every year. Compounded over 0 years of retirement, that's a devastating erosion of your standard of living. Meanwhile, businesses that can raise prices with inflation protect and grow your wealth automatically. This doesn't mean you should own only stocks. It means you should understand what each asset class actually accomplishes. Cash provides liquidity for emergencies and opportunities. Bonds provide portfolio stability and deflation protection, but stocks of quality businesses provide the only reliable long-term protection against the biggest risk retirees face, which is outliving their money. The 7 companies I've recommended have track records spanning decades of providing this protection. They've survived world wars, depressions, technological disruptions, and regulatory changes. Their business models have adapted while their competitive advantages remained intact. That's what you're buying when you purchase their shares. But ownership requires patience that most people don't possess. These businesses will face temporary setbacks. Coca-Cola will deal with health concerns about sugar. Microsoft will face new competitors. Walmart will navigate changing retail patterns. The media will declare each challenge existential, and stock prices will fluctuate accordingly. Your job as an owner is to ignore the noise and focus on the fundamentals. Are people still getting sick and needing health care? Are consumers still buying household products? Are businesses still using productivity software? Are people still shopping for necessities? If the answers remain yes, temporary stock price movements are irrelevant. This long-term perspective becomes easier to maintain when you understand the mathematics of compounding. A 3% annual dividend that grows at 5% annually turns into serious wealth over 20 years, but only if you reinvest those dividends instead of spending them, and only if you don't panic and sell during temporary downturns. The reinvestment decision is particularly important for seniors because it determines whether your portfolio grows with inflation or falls behind it. Spending every dividend payment might feel good today, but it guarantees your income will have less purchasing power tomorrow. Reinvesting dividends during market downturns accelerates wealth building by purchasing more shares when prices are depressed. Most retirees make this decision emotionally rather than mathematically. They see their account balance drop during market declines and immediately want to preserve what's left by switching to cash. This locks in their losses and eliminates their ability to participate in the eventual recovery. It's the exact opposite of rational investing behavior. The companies I've recommended make this emotional discipline easier because their business performance usually diverges from their stock price performance during crisis periods. While Wall Street panics about quarterly earnings, these businesses continue serving customers, generating cash flow, and strengthening their competitive positions. Understanding this divergence between stock prices and business values is crucial for successful senior investing. Stock prices reflect emotions, expectations, and trading activity. Business values reflect customers, cash flows, and competitive advantages. Over short periods, emotions dominate. Over long periods, economics dominate. That's why successful investors focus on business quality rather than stock price movements. They ask whether the company's competitive advantage is strengthening or weakening, whether management is allocating capital intelligently, and whether the business model remains relevant. Stock prices eventually reflect these fundamental realities, but often with significant delays and volatility. For seniors, this creates both opportunity and challenge. The opportunity is that market volatility occasionally offers chances to buy excellent businesses at reasonable prices. The challenge is maintaining the emotional discipline to act rationally when everyone else is panicking. Age should provide wisdom, but it often provides anxiety instead. The solution is preparation and process. Before the next market crisis hits, decide how you'll respond. Will you sell and panic or buy opportunistically? Will you focus on stock prices or business fundamentals? Will you make decisions based on fear or arithmetic? Having predetermined answers removes emotion from the equation when it matters most. These 7 stocks provide the foundation for that process because they represent businesses that benefit from crisis rather than get destroyed by it. Strong companies with pricing power and competitive advantages often emerge from economic downturns with larger market shares and better competitive positions. That's how they've generated wealth for patient shareholders across multiple generations. The portfolio construction itself deserves attention because most seniors approach it backward. They start with asset allocation percentages dreamed up by academics who never missed a mortgage payment. 60% stocks, 40% bonds. They chant like it's scripture. That's nonsense. You don't build wealth by following formulas. You build it by understanding businesses. When I allocate capital, I think about concentration versus diversification. Diversification protects you from ignorance. Concentration amplifies knowledge. Most people need diversification because they don't understand what they own. But if you truly comprehend these 7 businesses, you don't need 50 others to feel secure. The mistake seniors make is confusing activity with progress. They rebalance quarterly, chase sector rotations, and trade based on economic predictions. All that movement generates taxes and fees while destroying compounding. The best portfolio is often the most boring one. Buy quality, sit still, collect dividends, reinvest them, and let time do the heavy lifting. Consider the tax implications of senior investing. Most retirees are in lower tax brackets than during their working years. That makes dividend income more attractive because it's taxed favorably compared to wages. Meanwhile, capital gains can be managed by timing when you realize them. Hold winners, sell losers, and use losses to offset gains when you need cash. But here's where most people get clever and stupid simultaneously. They chase tax efficiency at the expense of business quality. They'll buy a mediocre company yielding 6% instead of an excellent one yielding 3% because the higher yield feels better. That's backward thinking. Quality compounds, yield traps decay. The 7 companies I've recome. NDE are tax efficient by design. They generate earnings that compound internally while paying modest dividends that grow over time. You get the best of both worlds, steady income today and growing wealth tomorrow. Compare that to bonds which give you fixed income that loses purchasing power, or growth stocks that give you no income at all. Estate planning considerations matter more as you age. These businesses aren't just investments, they're assets you can pass to children and grandchildren. Quality companies with durable advantages make excellent legacy holdings because they continue generating wealth long after you're gone. Your heirs inherit businesses, not just stock certificates. The stepped-up basis rules make this even more attractive. When you die, your heirs receive shares at current market value, not your original cost. That eliminates capital gains taxes on decades of appreciation. It's one of the few remaining tax advantages in the code, and it rewards patient investors who hold quality businesses for decades. This brings up a crucial point about senior psychology. You're not just managing money anymore, you're managing legacy. Every decision affects not just your REIT. Income's both shorter and longer. Shorter because you have fewer years left. Longer because your money needs to last through retirement and beyond. That combination requires deep understanding of business durability, not superficial knowledge of market timing. Warren taught me that risk comes from not knowing what you're doing. Most seniors increase their risk by decreasing their knowledge. They delegate investment decisions to advisors who don't understand their specific needs. They buy products they don't comprehend because someone else recommended them. That's dangerous at any age. It's fatal in retirement. The 7 stocks I've recommended are knowable. Their business models are simple enough to explain to a child. Their competitive advantages are visible to anyone who pays attention. Their financial statements are transparent and consistent. You don't need an MBA to understand why people buy Band-Aids or use Microsoft Office. This simplicity is a feature, not a bug. Complex businesses are harder to monitor and easier to misunderstand. When something goes wrong, and something always goes wrong, you want to recognize it quickly. Simple businesses reveal their problems early. Complex ones hide them until it's too late.